Hi, everyone. This is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is a commodities expert, a former vice president at Sprott. He's worked in the commodity sector for decades as a credit analyst. He's helped finance many mines and mining companies over a long career. Rick Roll, thank you for joining me again.
Jason, a pleasure. Thank you for having me back.
So, Rick, we were discussing this before I started recording. I want to get your thoughts on how bear markets in the mining sector and the commodity sector normally play out, because the average person listening to this that might be new to what a bear market is in the mining sector, you've been through more bear markets than I have. I was in the bear market in 2008, 2009. The bear 2015, 2016 was absolutely brutal. I was getting emails, text messages that Silver Wheaton, Pan American Silver were going to go bankrupt. I was getting these daily. How do things normally play out then in a bear market for commodities and mining companies?
I guess there's five things that immediately come to mind. A bear market, depending on whether it's merely a bear market in commodities or a generalized bear market, may result from or may result in difficult economic times. Difficult economic times, of course, lower demand for mineral commodities and hence often lower prices. So irrespective of the impact on equities markets, a bear market, if you call a bear market an economic recession, can cause mines to close or become less profitable simply because the price of what they're selling declines. A more common definition of a bear market has to do with a bear market in the equities prices of mining companies. This simply raises the cost of capital. For companies that are looking to put a mine into production, or for companies that have a mine in production, but a mine where the economics are marginal, where they are still consumers rather than generators of capital, bear markets can be absolutely deadly. In a capital-intensive business, not having access to capital and or affordable capital can be a killer. Commonly in bear markets, the lenders look at the sentiment around equity markets, thinking that if worse comes to worse with the loan, the issuer can bail them out with an equity issuance. And that confidence simply isn't present in a bear market. The third thing to know, I guess, about a bear market is that very often investor sentiment, like the investor sentiment that you experienced yourself with incoming phone calls, becomes unnecessarily bearish. Which is to say, despite the very bad circumstance that we're going through, the expectation in bear markets is often for worse circumstances to follow. I have made most of the money that I now enjoy by having the courage to write checks in bear markets when the expectation of the future is at a decided discount to the reality that we're facing with regards to the future. And remember, too, my friend Doug Casey once said that bear markets don't cause assets to go away. They just cause them to change hands, going from the impatient holder to the patient holder. Bear markets are a weeding mechanism, both for assets and for investors. I think the final thing that you need to know about bear markets, at least general securities bear markets, is that very often bear markets result in a decided increase in government-sponsored liquidity, artificially low interest rates, quantitative easing, the very things that set in place the inflation that often has been very good, in particular for precious metals pricing. So 5 things in summary that you need to know about bear markets.
So you mentioned demand destruction. Have you been in bear markets where there's also supply destruction happening at the same time as the demand destruction, and then maybe the supply destruction is actually occurring faster than the demand destruction?
Demand destruction happens first, but supply destruction can last longer. Remember that mining is a capital-intensive cyclical business. If you shut down a mine, it may be years before you could reopen it. An example would be an underground mine where it in fact fills with water. When it fills with water, it isn't just that you need to pump the water out, it's that the electrical system in the mine, often the ventilation system in the mine, all of that goes away and has to be rebuilt. So the supply destruction can last much longer. than the demand destruction. They seldom occur simultaneously. The demand destruction usually comes first, the supply destruction after, the supply destruction lasting longer.
So I'm looking at the earnings for a lot of these mining companies, the gold miners that also have a lot of copper. They're copper and gold mines. They're large open pit mines. I'm looking at the costs. And for Newmont Mining, the costs for Newmont Mining are up enormously the last 2.5 years. They operate a lot of low-grade open pit copper and gold mines. Do you think then that they're looking at, if metals prices go lower, potential supply destruction? Are they considering, they have some mines that have over $1,500 an ounce costs? If gold prices and paper gold prices are a little over 1,700 when we're recording this interview on Wednesday, November 9th, 2022, if gold prices were to say to go $100, $150 an ounce lower, would some of these larger open pit miners that have low grade, because their costs are so high with diesel and labor, would they consider putting these mines on care and maintenance?
Initially, the answer to that, surprisingly, is no. It's noted for two reasons. When you look at the costs that are reported by Newmont, those costs include depreciation, amortization, and depletion, which is to say these are paper as opposed to real costs. What you see is that most of the large mining companies will continue to mine as long as the project generates cash being different than profits. The second thing is that it costs money to shut a mine down, and it costs more money to reopen the mine. So the larger, well-capitalized miners try to win what we in the business call the last man standing contest. In other words, they try to avoid shutting down their production, hoping that other people will shut down their own production first, that the prices will rebound and that they can enjoy the margin on the rebound before other people can reopen their mines. Remember that while the operating costs in these mines are significant, often they are less significant when you compare them with the upfront capital cost that it took the mine into production. And understand that the debt on a great big mine, when it shut down, has to be paid back from the production of other mines. So the supply response that you would expect in a less capital-intensive business is much slower in the mining business than in other businesses because of the relationship between operating costs and capital costs, and also because of the extraordinary cost of shutting down and reopening mines.
Yeah, I've tried to explain this to the average person out there. So if you own a bunch of McDonald's franchises and a couple of the locations are doing poorly, you can close those locations easily, cut your costs. It's very different in mining to shutting down mines. I mean, if you put a mine on care and maintenance, you're not generating any cash flow, and you may as well just light your cash on fire if the mine's on care and maintenance, because your costs are going through the roof.
Accurate.
And then the other part with the mining sector, Rick, is normally to lower costs for a lot of these mine companies, they have to make enormous capital investment.
They do two things, Jason. One, as you suggest, is that they incur capital investments. The other is, they don't like to say this, they call it optimization, which is a different way of saying they high grade the deposit. If the average grade, as an example, in a nice surface deposit is 1 gram, there might be 1.75 grams or even 2 gram sections. During periods of low prices, the companies will often take out the sweet spots, the eyes of the deposit, to stay alive on a cash basis. What this does is it devalues the mine for the rest of time, because you can't blend this high-grade material with low-grade material. And there has been an awful lot of, I'll call it shady activities, where when the mined grade of a mine exceeds by a substantial margin the average grade of a deposit, and where the company is in fact mining the high grade, but they don't increase the depletion charge, understanding that they're taking the most valuable part of the deposit out now, where they account for depletion on a units of production rather than mined grade versus average grade basis. Companies can be very, very tricky with the way they report their operations during periods of low metals prices.
I think the the all-in sustaining cost that came out, 5, 6, 7 years ago, is a lot better metric than the old cash cost number. I mean, the cash cost number used to include very, very little. It was a guessing game. The all-in sustaining cost tends to be closer to the real cost for a lot of the miners.
All-in sustaining costs is good, but not great on a company basis. All-in sustaining costs does not include the cost of capital, nor does it include prior year write-downs. And so while all-in sustaining costs can be useful on a deposit by deposit basis, all-in sustaining costs really on a corporate basis should take into account prior year write-downs. They should take into account cost of capital, and they should also take into account the collective take, which is to say royalties, taxes, and non-tax benefits paid by the company to the community.
So with the mining companies reporting rising costs, their cost of capital's up, I think labor costs are probably the next shoe to drop for a lot of these mines that operate in emerging markets. I expect higher labor costs for a lot of these mines. Their profit margins are being evaporated for some of them, at least, if they're not a high grade and low cost mine. Do you expect supply destruction then in the next 6, 9, 12 months? Because I was speaking with another gold company executive, and he was telling me a lot of these base metal miners that have gold byproduct and silver byproduct, they went cash flow negative at their base metal mines about 8 weeks ago. So do you think then that potentially we're looking at supply destruction if this continues with the profit margins being eroded, lack of capital, lower metals prices?
I think you'll see supply destruction in the smaller, less well-capitalized mines. The large mining companies, base metals mining companies included, have enjoyed such spectacular income in the last while that they've paid down their debt fairly substantially, and they are able to operate in this last man standing contest. What I do think you'll see, well, two different comments. I think that absent a worldwide recession or depression, that you're going to see a supply cliff anyway. The current base metals prices, with the exception of iron ore, are well below the incentive price necessary to bring new mines into production. And society is living, for the most part, on deposits which are as old as I am, which is to say, well past their prime. So irrespective of a very ugly synchronized global recession or depression that really lowers demand, you're going to see a supply cliff, irrespective of the current impact of cash flows. What cash flows will do is limit the ability of companies to make sustaining capital investments. In other words, they won't shut the mine down, but the mine 2 or 3 years from now will be much less productive as a consequence of deferred sustaining capital investments. And they will also disincent, particularly in the copper business, new mine construction, which the world as a whole desperately needs.
And a lot of these base metal miners and copper miners, if copper prices either go lower or stay flat for a while and diesel costs stay high, labor costs rise, potentially you're looking, if you're an income investor and you are parked in base metal miners, you're looking at dividend cuts then.
I think that's very accurate. The mining companies have been generating so much cash and they're held in such low regard by institutional investors. The mining company managements have been forced to distribute surplus cash flow to shareholders by way of dividends or buybacks, to the extent that that free cash flow is in a lower quantum. One would naturally expect less of it to flow back to investors. It's important to note that one important byproduct that might occur as a consequence of what you're talking about, lower margins in base metals mines, it is very conceivable that you will see another round of sales of gold and silver byproducts to the streaming companies. That cash flow, the gold and silver cash flow from a copper mine, would be valued in the mining market at the copper industry multiple of earnings, which might be a 5 or a 6 or a 7. That same cash flow, the precious metals cash flow, segregated and identified as a gold or silver stream, would have a market capitalization of 15 or 16 times. So the arbitrage that happens from carving out gold and silver, which is to say precious metals cash flows, from large base metals operations, is one that is simultaneously beneficial to the buyer and to the seller. And one of the circumstances that you may see as a consequence of the margin squeeze in base metals mines is that existing mines sell stream and new mines rely increasingly on stream as part of the capital stack, certainly to the benefit of the great big royalty and streaming companies like Franco-Nevada, Wheaton Precious, Orion, and to a lesser degree, Osisko and Triple Flag.
Yeah, that's exactly what I was thinking. The longer that this plays out with base metals, either prices stay flat or go lower, the margin squeeze, lack of capital available, dividend cuts. Historically, in bear markets, you see Franco-Nevada come in and just start increasing the amount of deals because the business model is countercyclical. You look at all the deals that Franco has done the last 12, 15 years. A lot of their best deals have been done in bear markets and weak metals prices. They deploy the cash, and then 2, 3, 4, 5 years later, it pays off big.
Absolutely. Completely concur. I think what you're seeing too, and Randy Smallwood from Wheaton has done a very good job of explaining this to the market, is that because of the earnings arbitrage, which is to say, because of the fact that the market values precious metal streams much more than they value base metals free cash flow, that it is often, meaning the sale of the stream to the royalty companies, or streaming companies, often the lowest priced quasi-equity available in the capital stack. And I think in terms of new mine construction and mergers and acquisition, what you're going to see is the increasing prominence of streams, both in acquisition financing and in construction financing. Randy Smallwood makes the point that very often now in new mine construction, the sale of the stream generates 70 or 80% of the equity that's put in a project in return for a much lower proportion of the total revenue stream, which is to say the sales stream from the mine.
Is this because it's so difficult to get bank debt? It's a long time consuming process. There's a lot of bureaucracy, red tape. It could take over 6 months for approval for bank debt. Whereas with a streaming company like Franco-Nevada, they have their revolving credit facility. They have free cash flow, high profit margins. They can make a decision a lot faster than in 6 months or longer.
That is one reason. The other reason is that with regards to a bank lender, their upside is limited. They don't need or they don't get to look at the upside of a project. All they look to get to is their money back with interest, which is to say that there is a difference in potential outcome between the streaming company and the bank. At the same time, the bank multiples, the that the banks enjoy, are much lower than the multiples that the royalty and streaming companies enjoy. So the royalty and streaming companies, at least on an equity basis, have a lower cost of capital than the banks. And as a consequence of that, are much more efficient capital providers, at least in the riskier parts of the stack. You will note that the stream either ranks pari passu or subordinate to the secured credit facility. Further on credit, you need to understand the fairly major difference in securing bank financing, at least in terms of the price paid for the money, between investment grade borrowers, which is to say companies that can borrow against their balance sheet with recourse to the property, as opposed to project borrowers, people who don't have enough balance sheet strength, so that the entire effective collateralization of the loan is against the property. Those borrowers, which are non-investment grade borrowers, are frequently borrowing at a total cost of capital that can be 15%. The credit-based borrowers are borrowing at rates of return that are prime-based, so between 4 and 5%. So the difference between investment-grade borrowers and non-investment grade borrowers for construction finance can be as much as 10%.
And that was before the Fed was hiking rates, right? So now the Fed is hiking rates, and all this junk bond debt is going to be priced up much higher interest rates off the U.S. Treasury yield curve with the rate hikes.
As will, of course, the investment grade. What you are seeing, I think, or let me rephrase that. What I think you'll begin to see in the non-investment grade market is that some of the providers of capital in that market those that are spread lenders. A spread lender is a lender that borrows some of the money that he or she reloans. I think that you're going to see a tightening of lending standards in the so-called junk market. I think you're going to see increased cost of capital for capital providers in that market. So I think that you're going to see a lowering of availability in the below investment grade lending markets. There has been, in the last 10 years, as a consequence of very low interest rates, increasing interest in the non-investment grade lending space. You may know that my former employer, Sprott Inc., where I'm still the largest shareholder, has enjoyed excellent on-balance sheet and also partnership returns in the lending business. Those returns have attracted a lot of competitive capital. We expect now, with the turmoil in the non-investment grade credit markets, that the amount of money in the non-investment grade space will begin to go materially lower.
So last time you were on the show a couple months ago, I think over summer, June or July, you were talking about potentially much larger mergers and acquisitions in the royalty and streaming space. We've had Sandstorm do a large deal buying Nomad. It seems that the valuations for a lot of these small and mid-sized companies are below 10 times cash flow. Do you expect a lot more mergers and acquisitions for these larger senior precious metal royalty and streaming companies? Because once it's a larger company and they have a pool of diversified cash flow, doesn't it make more sense that they can increase diversification and do even more loans, finance even more mines?
I think it should happen. I think it should happen for many reasons, the most important of which is that to the extent that a merger lowers the general and administrative cost relative to assets under management and relative to free cash flow, that it results in a stronger business. It is also true that larger companies generally have more trading liquidity. With a higher trading liquidity, they have higher share prices and hence a lower cost of capital. What argues against amalgamation now has been the fairly rapid increase in nominal interest rates, which means the cost of capital for the acquiring company, if they were partially financing the acquisition with debt, goes up. The second problem, of course, is the fact that every management team in the business wants to continue to get paid, which means that everybody wants to do takeovers, but nobody wants to be taken over.
So then it's a question of overpaying on a premium or some type of multiple then, because they don't want to give up their salary and their stock options and all the other perks of running a royalty and streaming company in a bear market.
Yeah, what you sometimes see is mergers of equal, like the Altus Elementa royalty, where both teams had to make some painful cuts and pieces of both teams prevailed. That happened, I think, because of the large shareholder at Altus, La Mancha, who was willing to backstop the combined companies and lower the combined companies' cost of capital externally, enjoying both the lower cost of capital that might occur from greater scale and liquidity, but also having the backing of a billionaire who decided that he by himself would lower the cost of capital to the resulting company by guaranteeing their revolving credit facility.
So now I want to transition to uranium. We're seeing just record high energy and electricity prices all over the globe. Do you think that this is a good case for why nuclear power could provide much cheaper and efficient baseload electricity?
No brainer. Absolute no brainer. What we're seeing, I think, around the world is at least three convergent trends. The first being the resurgence in concern about geopolitical availability of energy supplies. The hostility, as an example, between Russia and the West. The emerging competition for resources between China and the rest of the world. Concerns are heightened around security of access to power. And there is no power from that point of view that is as secure as uranium, simply because it is so dense. A small amount of material generates an enormous amount of electricity. The Japanese nuclear fleet was really built on a premise that came out of the Arab oil embargo in 1973. The Japanese came to understand that the only material that gave them any help for energy self-sufficiency was uranium. Two events conspired to get in the way of that. One was Fukushima, which showed them something about the cost of catastrophic failure. But the other was the wide availability of energy alternatives to Japan, alternatives that exist with less and less frequency. The second thing to consider is that many members of the environmental community, many people who have a concern, legitimate in many regards, about the impact of carbon loadings on the atmosphere, have come to understand that you are not going to reduce carbon loadings by asking people to lower their material standard of living. And so you need to increase the availability of energy, particularly baseload energy, in a way that doesn't generate carbon. And nuclear energy does precisely that. The third thing is the realization among many elements in society, but in particular among investors, that the future of electricity is not just about electric cars. It's about the fact that 1.2 billion people on Earth have no primary access to electricity. Another 2 billion people on Earth have access to intermittent or unaffordable electricity. Separate and apart from the increasing electrification of the Western world, the developed world, the gradual transition, and I do mean gradual, from the internal combustion engine to the electric engine, a big part of the future of electricity is simply the increasing material living standards of humankind itself and the increasing number of people on Earth. These factors also have gone to the understanding of the investment community that the world is going to need increasing amounts of all forms of power generation. Wind, yeah. Solar, certainly. They hate to admit it, but oil and gas, carbon is here for a long time. And of course, nuclear.
And China's importing massive amounts of coal, but nuclear power is very cheap electricity, especially for baseload. Now you're starting to see these countries that were manufacturing powerhouses, they were reliant on very cheap energy and electricity costs. But once there was a big spike in energy prices and electricity costs, and in Europe, costs are up $1,000 a month or more for the household at the family level. At the business level, it's even higher than that with electricity costs, with BASF and a German soap manufacturer being insolvent with their inputs. It makes a lot more sense for these countries to stick with nuclear, because then you're not relying on importing liquefied natural gas or coal at these sky-high prices.
Understand that what works for the country doesn't necessarily work for the political class.
Well, as long as they can go to Davos, right? They don't really care.
Right. I mean, an important part of the political class's estimate is getting reelected, and campaign contributions from the likes of the WEF or Soros are probably more important considerations than the material well-being of their citizenry. Much of Europe's difficulty was self-inflicted. The idea, as an example, in a northern climate like Germany, where the sun doesn't shine, that you would rely on solar power is probably a fundamental mistake. I'm not belittling, by the way, the fact that the Germans came to rely fairly exclusively on Russian oil and gas and made a strategic miscalculation. But I reiterate, Jason, the fact that growing world populations, the wonderful trend to increasing well-being, material well-being among all levels of society, and the under-electrification, the under-access to power enjoyed, if that's the right phrase, by almost half of humanity, suggests that we're going to have to fashion a political consensus on a global basis that increases the supply, at least the supply of all power, which can be generated in an economically attractive fashion. And that includes, particularly for baseload power, uranium.
Cameco, the last 6 weeks, actually, there's been a lot of interesting news stories. They did a large acquisition of Westinghouse. So that's the supplier. They make original equipment manufacturing for a lot of nuclear power plants. So they're getting involved in that part of the business. I guess they expect a lot more countries to build nuclear power plants. They acquired Westinghouse, which is a proven name in the nuclear power space. And then just this week, they announced a large supply deal. And unfortunately, the contract terms are not disclosed publicly because it's with a Chinese agency. It's with the Chinese Nuclear Power Agency, a supply deal. So the largest nuclear power agency in China, Cameco, is going to be supplying uranium offtake potentially for decades.
Both important, both interesting topics. The one between Cameco and the Chinese is fairly easy to deal with. Cameco has a lot of sources of uranium around the world and a lot of spare capacity, which is important. The Chinese recognize their ongoing need. The Chinese have made a commitment to nuclear power that predates the current resurgence in nuclear power. It is regarded by them as a strategic asset. It's important to Cameco because really ever since Fukushima, there has been an oversupply of uranium, which has only ended very, very recently. And uranium consumers have had the upper hand in the market, which meant that more and more of the product in the market sold in the spot market. There were two problems with that. One, the spot market price was below the total cost of production, which meant it was economic. But the other was that the volatility of the spot market precluded big producers like Cameco and like Kazatomprom from returning some of their surplus production, their redundant production, to market. The importance to Cameco of the announcement this year of 75 million new pounds contracted into the long-term market is that although the terms are confidential, if those terms are shown to banks, those terms can lead to the resumption of production, of shut-in production by Cameco. Cameco has said that they wouldn't return the marginalized shut-down production to production until they had enough of the output contracted at long-term prices that generated reasonable returns on capital employed. That's the important thing about that announcement. The Cameco Westinghouse transaction is fascinating. On the one hand, it shows faith by Cameco, a very important global uranium company, but also, importantly, by Brookfield, one of the largest infrastructure financiers in the world, in the nuclear business. This will, for Cameco, if they are successful with it, be an enormous strategic advantage, because Cameco goes from merely selling uraniums to ultimately selling watts, which is, this gives them the ability, in conjunction with Brookfield, to not only provide components for nuclear power plants, not only provide fuel, but actually build, own, and operate nuclear power plants themselves. The scary part of the transaction, from my point of view, is it takes Cameco out of a business they know extremely well into a business that they have aspirations to enter. In other words, the idea is great. What will the implementation look like? That's what scares me.
Yeah, well, it looks like they have the partner, the infrastructure partner, to help them out with that. So they're not going to be firing all the Westinghouse people. That's going to be in-house brand. So the Westinghouse people are going to be in charge of the nuclear power plant equipment and manufacturing. And then Cameco's what? They're selling it to investors as we're vertically integrated. So we mine the uranium, we're building the nuclear power plants, we're getting revenues and profit margins at each stage of the value chain here, and we're making a very big bet on nuclear power growing and uranium demand growing.
That's the narrative. I'm always concerned about.
Yeah.
I'm always concerned about the realities. I've seen some companies succeed at integrated value chains. ExxonMobil would be a great example. I've seen other companies, as an example, when BHP was in the steel business, fail fairly miserably, take upstream profits and lose them in downstream losses. So I will watch with interest the way that Cameco manages the Westinghouse acquisition. Cameco, too, has evidenced a lot of interest in growing in, in effect, recycling capabilities, enrichment and re-enrichment. Right now, about 40% of the world's enrichment capacity is in Russia. And the world sees the need, as a consequence of geopolitical challenges, of building enrichment capacity outside of Russia. Westinghouse is a leader in this technology too, and I suspect that much of the world, in particular the United States, would be more comfortable with Canadian enrichment capacity than they would with Russian enrichment capacity. Further, Cameco sees the opportunity to go into the waste disposal business, which means that you could see in Cameco full integration from mining uranium through trading uranium, through reprocessing uranium, through selling watts, operating nuclear power plants, all the way to nuclear waste disposal, a true integration. Whether they can pull this off is a different question.
Yeah, I mean, Areva in France tried to do this, but it was very inefficient and poorly done. So there's been a long history in the commodities business, whether it's Molycorp in rare earths, where they tried to buy all those small rare earths processing in the value chain, and that failed. They used shareholder capital and wasted billions of dollars. So in theory, it sounds good. We'll see what happens in practice if they're actually successful with it, because even that's a government-backed entity in France with Areva, they've had a lot of problems for decades too.
That's accurate. I'm hopeful. I really think that the partnership between Cameco and Brookfield, utilizing the Westinghouse technology, could allow those partners to build, own, and operate greenfields nuclear power plants, all the way from gigaplants down through small modular reactors. I think that's ultimately the game plan for both partners. And if they can manage that process, the access that Cameco has to most aspects of the business and the access that Brookfield has to financing $5 or $6 billion projects gives them an outrageous opportunity, I think, in uranium, if they could manage it.
So a lot of people are not aware of this. You also used to work in oil and natural gas as a credit analyst and also helping finance those companies many years ago. Is there still long-term demand growth for oil and natural gas? Because it seems like there's supply problems from OPEC and OPEC plus. I mean, OPEC plus production in August, it dropped by almost 4 million barrels per day. In October, the new numbers over 3 million barrels per day. It's falling off a cliff on its own. So do you expect then long-term demand growth for oil and natural gas and supply problems going forward?
Yeah, Jason, you make a hell of a point. There was a lot of press attention made to the fact that OPEC lowered their quotas by 2 million barrels a day. They were already 1.4 million barrels a day supply impaired from the old quotas. So the cut, to the extent it happened, wasn't 2 million barrels, it was 600,000 barrels. The more important thing to consider with that is that the lowest hanging fruit in decarbonization is the substitute of natural gas, liquefied natural gas, for coal. The developed country that's made the greatest progress in decarbonizing electrical generation is the United States, as a simple consequence of substituting burning natural gas for burning coal. This isn't consistent with what the big thinkers want to happen, but it makes absolute sense. The biggest driver in oil and gas prices is going to be the systemic underinvestment by the oil industry in sustaining capital and new project investments. You have President Biden, at the one hand, telling the United States oil industry to increase supplies and cut prices, while at the same time he tells them that he's going through legislation to make all of their producing assets redundant by 2030. How can you get somebody to increase sustaining capital investments when you tell them that you're going to put them out of business in 8 years? I would expect myself peak oil demand to occur sometime between 2040 and 2045. But if you have demand only holding steady between now and 2045, and you are reducing sustaining capital and new project investments to the tune of $1 billion a day, $365 billion a year, what you are doing is constraining supply and maintaining high prices for those companies, who are solvent enough and willing enough to reinvest enough of their free cash flow to maintain their productive capabilities while the rest of the world's productive capabilities decline.
Yeah, I mean, OPEC, the national oil companies, OPEC and OPEC plus, they control the majority of the world's oil and natural gas reserves. It's not Chevron or ExxonMobil that controls the majority of the reserves. It's OPEC and OPEC plus countries. So if they have production collapsing, they're not making reinvestment into CapEx and reserves, then you're going to have supply problems.
Well, if you look at the last 20 years in both Mexico and Venezuela, those are state-controlled oil and gas companies. And in both cases, the countries have made the decision that rather than reinvest in sustaining capital for their oil industries, that they would redistribute the money to more politically expedient domestic spending programs in both countries, ironically, subsidizing the price of things like kerosene and gasoline. In other words, increasing demand while decreasing supply. The results for both countries in terms of their ability to produce and the free cash flows that their industry generates has been catastrophic. Remember that this is a capital-intensive business. If you don't make the sustaining capital investments, you cannot maintain production.
Oh, I totally agree. The average person doesn't understand this. And that's earlier in the discussion, that's what we were talking about, the difference in the natural resource business between mining, oil, and natural gas fertilizer companies versus a business in another industry. You can cut costs and still maintain a lot of your revenues in another industry. The mining, natural resource sector, you can't do that.
Very good point.
And since you brought up Latin America, I want to get your thoughts on the elections in Latin America the last 3, 4, 5, 6 months. The recent elections were in Brazil and Colombia. Do you think it's still safe as a resource investor to make investments into Colombia, Brazil, Chile, these countries, or is it becoming anti-mining because of ESG policies or pro-socialism or just new taxes maybe on some of the miners that were put on 6, 12 months ago when copper prices or other metals prices were higher?
I'm, of course, distressed by the decisions that have been made by voters in the countries that you mentioned. I'm distressed, too, by the decisions made by voters in the United States and Canada. And I think that the whole question of political risk revolves around the price that you pay for it and the quality of the asset that you are discussing. My worst personal experience with political risk occurred in the People's Republic of California, where the political class in California delayed mine permits for 13 years, obliterating the net present value of the deposit. Remember that money that you enjoy 13 years from now at a discount has no net present value. So when I hear mining industry investors talk about political risk and act as though the United States and Canada are the baseline for political risk, which is to say risk-free countries, I beg to differ. I don't see any particular difference between money that's stolen from me by white people in English in the legislature according to the rule of law and money that's stolen by other more traditional methods. And while I understand that, as an example, Lula or others will be potentially less friendly to mining in than their predecessors, what I do know is that politicians are often more pragmatic around mining and oil and gas when it is of more importance to their country than would otherwise be concerned. An instructive illustration of this has to do with the very recent actions by the voters in Chile. The newly elected socialist government proposed very broadly based tax and constitutional changes that would have negatively impacted the mining business. The mining business, in turn, generates 33% of gross GDP, but more importantly, almost all of the economic margin in Chile. The voters had the good sense to tell the newly elected left, while we agree with many of your ideas, keep your hands off the goose that lays the golden eggs.
And for our listeners out there, Chile is the Saudi Arabia of copper. So they produce the majority of the world's copper. Peru used to be up there, but they've had declining production from copper and silver now for the last 5, 6, 7 years. So do you think, I think an important thing that you just brought up in the last couple of minutes with the politicians is they tend to do flip-flopping. So they'll do a 180. So if metals prices crash, so if copper prices go below the cost of production, the copper companies, the large copper companies say, we're not making investment. They threaten to pull, shut down mines or pull investment dollars that were going in. The politicians will say, okay, we're holding off on this. They'll do a 180 and things will change. I think that's what the average person doesn't understand is how quickly things can change based on metals prices or a political backlash.
I think politicians will steal whenever they can.
No argument there.
A circumstance where there's not much to steal limits the scope of theft that one could experience. I remember some years ago in Argentina when Ms. Kirchner decided to steal YPF, the oil company there. And many people called me or wrote me and asked me questions about the mining industry in Argentina. And I, in turn, got in touch with a couple of my Argentine colleagues and asked what Ms. Kirchner might be expected to do with mineral assets in Argentina. And the answer I got back was illuminating. Most of the mineral assets in Argentina at that stage were in the development or pre-development stage, which is to say they generated no cash. What they pointed out to me is that Mrs. Kirchner was able to steal $1 billion a month with YPF. When if she stole the mining industry, what she would get in return was the requirement to spend $50 or $60 million a month. So what they said is that mining assets aren't attractive to steal until they're already built and generating very large margins. Governments can be relied upon to do what they're elected to do, which is to say, steal money from society to reward specific constituencies. If there's no opportunity to steal, the government is seldom so mischievous.
And Argentina seems to be pro-mining in most of the provinces, except for where the large La Navidad silver mine is that Pan American Silver owns. They had the bad luck of buying that asset, 8-10 years ago, and it's still not in production.
That's correct. That is correct.
Do you think that asset...
It's interesting to note that the opposition in that province to mining comes more from the resort communities in the Andes and not so much in the dry pampas where that deposit exists. It is true, too, that a Cacique family really has controlled that province for a very long period of time. And there have been suggestions, I can't confirm or deny them, that family created a problem in return for which they hope to be paid for solving it.
Wow. Well, it's not helping Pan American Silver, and Pan American Silver has their costs at their gold mines up enormously. Pan American Silver, actually, they used to be the low-cost producer in the silver mining space for many, many years, 10, 15 years, and now they're having a lot of problems the last couple quarters.
They are, in fact. Pan American spent a lot of money acquiring assets that are currently redundant assets. In addition to the asset in Navidad, of course, they have the asset in Guatemala. Between those two assets, they have 1 billion ounces of high-grade silver, which they paid a lot of money for, that they can't produce. What I like about Pan American Silver myself is that when investors look at Pan American Silver, they don't give them any credit for having 2 of the 5 highest grade and largest undeveloped silver properties on the books, paid for, but not producing.
Well, they have a lot of near-term balance sheet problems, though, because their mines, some of them are cash flow negative now. I think their cost for some of the gold mines were around $2,000 an ounce in the last quarterly report. So they're gonna have to make some significant capital investments to cut costs.
I think what you see in terms of the latest acquisition or proposed acquisition of Yamana in partnership with Agnico Eagle acknowledges that fact. The dilution that existing Pan American Silver shareholders, including myself, suffer by what is, from their point of view, an equity transaction to acquire the Yamana assets is a bet that they will be able to redeploy the newly generated Yamana cash flow in a way to grow the rest of the company. In other words, the hope is that the returns on capital employed will exceed the cost of capital, which in the case of Pan American in this acquisition was very high.
Are you talking about Gold Fields buying Yamana? Because didn't Gold Fields submit a bid, or was there a competing bid that I missed?
Yeah, you missed it. A week ago, Yamana announced that it had accepted a revised bid from a partnership between Agnico Eagle and Pan American. That bid would see Agnico Eagle get the remaining 50% of their Malartic operation, which they were in partnership with Yamana, and Pan American take over most of the rest of the assets of Yamana, in particular the South American assets, which would double Pan American's silver production and more than double their gold production, should the transaction occur.
Yeah, Cerro Moro, the silver and base metal mine, copper, silver, base metal mine in Argentina, that's actually been one of Yamana's best mines. I know there was a lot of negative backlash about Yamana putting into production. The mine's going to get confiscated. I was hearing all these things. Sandstorm Gold did a silver stream on the deal at the time, 2015, 2016. They were criticized for it. Oh, the government's going to steal it. It's made enormous sums of money. The reserves keep growing. I think they're expanding the mill. So it's a big cash cow.
accurate.
Rick, so you're clearly still bullish on silver. I mean, the sentiment, the physical silver at the bullion dealer selling well. The silver miners, not so much. Do you think that there's going to be a change in discrepancy at some point, because the miners are not benefiting from the prices that the bullion dealers are making when people buy silver eagles?
I don't see it as a certainty, but I see it as a probability. I believe that we are early on, very early on, in a precious metals bull market. I believe that eventually the narrative around debt and deficits and negative real interest rates will cause disintermediation from the long bond market to markets that are more inflation sensitive. There's no markets more inflation sensitive than gold and silver. Will that occur this year? I don't know the answer to that. It requires a triumph of arithmetic over narrative. In my experience in prior precious metals bull markets, these bull markets are led by gold. They're led by the fear buyer. They're led by people who buy metals for insurance purposes. But after the momentum has been established by gold, when the narrative goes further through the investment community, the higher volatility asset, silver, takes over. And in the latter half of a precious metals bull market, my experience has been that silver moves considerably further and considerably faster than gold. I'm not saying that this is a certainty, but I've seen it happen several times before in my career. And I think from my viewpoint, it is a contingency or even a probability worth speculating on. A certainty? No. Don't use money that you need for your rent.
It seems that a lot of foreign governments and foreign central banks, despite the Fed hiking rates, are not big buyers of U.S. treasuries lately. The demand for treasuries is down, even though the dollar on a relative basis is strong, maybe because these other countries are not running trade surpluses. But we've seen the numbers that come out recently. A lot of these governments are big buyers of gold. In the third quarter of 2022, there was a record amounts of gold tonnage purchases by central banks, the most since 1967 when the London gold pool ended. So clearly there's some hedging going on by governments and central banks against the dollar and the Fed.
You're seeing two things. Very small emerging and frontier markets that value liquidity are still large buyers of U.S. Treasury simply because they need the yield. They also need the yield in U.S. dollars because their own debts are denominated in dollars. So the reported disintermediation among governments worldwide from long-dated U.S. Treasury debt is overreported. The countries that are shunning U.S. Treasury purchases, I believe for good reason, are often countries who are concerned about the extraterritorial imposition of U.S. will on their own policies. Countries like Turkey, countries like China, countries like Russia. And the disintermediation out of U.S. dollars into gold is very, very real there. So I think there is bifurcation. It is interesting to note that while even the countries who don't want to hold U.S. treasuries buy gold as opposed to buying government securities denominated by other fiat issuers. So I think there is an undercurrent of understanding that gold is an asset class that holds its value through periods of turmoil. And some of these countries, for reasons political and apolitical, have decided to diversify at least their asset class away from treasuries into gold.
Also, the consumer price index, the government's official inflation rate, which I don't think is the real inflation rate, that's still way above the interest rates that people can make buying different yields on the U.S. Treasury yield curve. So you're going to be paying taxes on the interest payments on the bonds, but it's still below the government's official inflation rate. That's,
for me, the most important reason why the gold price is going to go up. Let's look at the arithmetic around the U.S. 10-year Treasury. You buy a 10-year obligation from the U.S. government, you will get paid back because they can print to pay you back. But they're going to pay you, 4.1% today in a currency that they acknowledge is depreciating by 8.9% compounded. In other words, the U.S. government absolutely, positively promises to decrease your spending power by 4.9% a year compounded for 10 years. It's one of the first promises they've made me in my 69 years on Earth that I believe they're going to keep. Now, imagine, Jason, that rather than being a speculator and a podcast operator, that you are the chief investment officer of a very large pension or sovereign wealth fund, And your investment mandate is that you will provide for the well-being of your constituents, be they workers or be they citizens, 20 years from now, 30 years from now, 40 years from now. For the last 40 years, bonds have been a wonderful place as interest rates fell, and for the most part, the US dollar remained strong. The consequence of that is that your portfolio composition, on average, is 60% equity, 40% debt. Now you're in a circumstance where you are being paid 4% in a currency where the purchasing power is declining by 9%. In other words, there is almost a guarantee that you will be unable to fulfill your obligation to your citizens or your pensioners. My belief is that to the extent that inflation remains high, which I believe it will, that the holders of long-term bonds, both corporate and government, will be forced to begin to redeploy those assets in long bonds, into other asset classes that have traditionally performed well during periods of inflation. I'm not trying to say that the trillions of dollars that these institutions hold in long bonds is all going to flow into gold and silver. It doesn't need to. The relative sizes of the asset class are such that what would be an insignificant flow of funds from the bond market into the gold market would have an outsized impact on the gold market. And I think it's much more likely than not to occur.
These large pools of capital, not only are they underinvested in gold and silver, they're also underinvested in conventional forms of energy. I mean, they've been investing in green energy and ESG for the last 10, 15 years. They did not invest in oil, natural gas, liquefied natural gas, coal, uranium. So there's been a drastic underinvestment, not only by the actual companies, the producers in the energy space, but also by the large pools of capital, the institutional investors.
Well, ironically, the largest pool of capital in the world is the Norwegian Sovereign Wealth Fund, Norges Bank, a capital pool that was built up entirely with the proceeds of oil and gas sales offshore Norway. The management of Norges Bank has now forsworn investments in oil and gas, I suspect for political reasons, even though the source of all that fund is oil and gas. I point this out only to amuse myself, but it goes to substantiate the fact that in the last 40 years, the economic climate has been so benign that the managers of the funds have often invested for political rather than economic reasons. I think that's going to change. I think the cost of capital around the world is going to go up, and the need to demonstrate returns on capital employed will result in a reversion to sanity on many layers, many levels in society.
The other ironic thing, Rick, is that Norwegian oil and natural gas producers, they're increasing production. They're making enormous profits and free cash flow, exporting oil and natural gas into the European Union and the United Kingdom at those high prices.
Correct. And kudos to them. The Norwegian exploration sector, led by our old friends, the Lundins, have done an absolutely spectacular job of finding massive new reserves in an old basin that already has fantastic infrastructure. There's nothing better than finding an oil field underneath an oil field where the mechanism for production and transmission is already in place. The Norwegians, too, have done a wonderful job in inflationary time, bringing this new production on time, on budget. And further, ironically, because Norway has wonderful and abundant supplies of hydroelectric power, the production of oil and gas in Norway occurs in a way that consumes, or pardon me, generates very, very little carbon. These offshore facilities are electrified with onshore hydroelectric rather than burning lease crude or lease gas.
So you're saying that they export more oil and natural gas rather than consuming their own production. Like some of these other Latin American countries, they subsidize cheap oil, cheap diesel at the pump, and the consumer consumes way too much of it. The oil company doesn't get any free cash flow or profits from it. It's like a political bribe.
Yeah, the Norwegians have been very pragmatic around their oil and gas production, even if they aren't too pragmatic around the disposition of the capital, ironically gained from oil and gas.
And the Lundin company you're referring to, that's Lundin Oil, that's on the Swedish exchange. So they have the assets in Norway and the North Sea?
Yes, they recently have agreed to sell those assets to a Swedish company, Aker, which will see the Lundin family become the largest shareholder in the Swedish company. The Lundins will keep, as a family in a public company, the Norwegian hydroelectric assets, which provide the power for these offshore oil and gas assets. But the offshore oil and gas assets, in particular the Stabroek field, will now pass from Lundin to Aker, with the Lundin family becoming the largest shareholders of Aker.
Well, Rick, you are a wealth of information. I really enjoyed our hour-long discussion on all these different topics in natural resources. My listeners want to follow your work. How do they do so?
Well, I'll bribe them. If your listeners care about my opinion on resources, particularly their resources, they're invited to go to my website, Rule Investment Media. Once there, you can list your natural resource portfolios, all the stocks and natural resources that you own. Please no crypto, please no tech, please no pot stocks. I'll rank your resource stocks from 1 to 10, 1 being best, 10 being worst, and I'll comment on individual issues where I think my comments might have value. In addition, if you're an accredited investor and you care about what private placements I'm going into with my own money, in the question and comment section on the rankings database, simply write placements, and I will send you, for no charge, at least at present, information about any private placement I do with my own money. I didn't used to be able to do this because I was securities licensed, and that was called soliciting. But I'm not soliciting if I don't charge or get a commission, so I'll do that. Further, Jason, as you know, I flunked retirement, and in retirement, I'm part of my 7th bank startup. Any investors who care about being invested in a real bank, one that has real money in it, one that lends against physical gold and silver holdings, are invited in that same Rule Investment Media rankings section simply to write in bank. And as information comes about this bank, we will forward it to people who are interested.
And you also had your conference a couple months ago, so you'll have another conference. Is it going to be in Florida? Do you know yet if it's going to be in Florida next year?
Yeah, we have a lot of conference stuff to talk about. You may recall, Jason, that we did a uranium boot camp last year, which was a virtual conference. It was a resounding success. So we're going to have 4 different boot camps next year on subjects like royalty and streaming, subjects like private placement, subjects like uranium, subjects like silver. In addition to that, we will have our annual physical conference. I don't know if this is my 30th or not. The attendees have voted, and the attendees prefer, at least for this coming year, Boca Raton over Vancouver. So next year's Natural Resources Investment Symposium will occur once again in Boca Raton, Florida.
Excellent. Well, thank you again so much for your time. I enjoyed this so much. I'm going to have to re-listen to this because there's a lot of useful information in there throughout the interview.
Well, thank you so much for the opportunity to visit with your audience. I enjoyed the process.